This is a question from the ACCA technical notes about construction of a factory. We have the construction costs here, freehold land costs, architect's fees, site prep materials, direct labour legal fees and general overheads. And some facts about the construction. It began 1st of April 2009. Was completed and ready for use on the 1st of January 2010 and actually brought into use on the 1st of April 2010. The company took a $25,000 unsecured loan on the 1st of April 2009, so the same day that construction began. Interest rate of 8% and repayable within 1 year. 2 years. 1st of April 2012. So let's take a look at which of these costs are we can put to CapEx. Well, it's most of them. We can do freehold land. It was of course a CapEx item. Architect's fees is a CapEx item. Site prep, anything that's going to bring the site to completion. So materials, yes. Direct labour, yes. Legal fees, if they are specific to the project, but not general overheads. We're going to assume by the wording of this that it's overheads that would have had to have been paid anyway, perhaps by administrators or managers, and although they might have been put towards the construction project, they would have to have been paid anyway, so we're not going to CapEx those. So that's our total for now. Let's just sum that up and see where we get to. So that's 28,170. Now let's have a look at finance costs. Construction began on the 1st of April and the loan came into being on the 1st of April on the same day. And we need to look at whether the asset is a qualifying asset. So let's just have a look at this. What are the criteria for qualifying assets? We need to say that expenditure has begun. We need to know that borrowing costs have begun. Let's just move that slightly. And that construction has begun. Actual activities have begun. So we can look and we'll see, well, has expenditure begun? The loan was in place on the day of the 1st of April. So clicking here, 1st of April 2009. So I think it's fair to say that expenditure has begun. Borrowing costs have begun. Sorry, I was talking previously. Construction began. So yes, expenditure on the construction has begun. Secondly, the borrowing costs have begun because it's on the same day. And has construction begun? Well, we're going to assume that it has. Construction began on the 1st of April. So these are our criteria for a qualifying asset, and they've all been met. And if they've all been met, we can capitalise the finance costs for that period and for that period only. So let's have a quick look about how much they might be. What was the total loan? Well, it was, let's put here finance, and it was 25,000 times 8% per annum. And for how long? What was the period? Well, it was started on the 1st of April 2009 and completed and ready on the 1st of January 2010. So all of April, May, June, July, August, September, October, November, December. So that's 9 months. So times 9 over 12. Let's just make that slightly larger. More moving things around here. So that's going to equal, I'll put it here, 25,000 times 8% times 9/12 is £1,500 of finance costs for the period the construction was taking place. And that means we can add that amount to the capex amount to give us a grand total of the construction costs plus the finance costs. 26,960 is our final capex figure. So this is for construction, 28,170, and this is the finance cost, which we can only call as qualifying while the construction's in place, while borrowing is being paid for, and when there's expenditure, after expenditure has begun. So that means there's some finance expenditure that we can't capex. So let's have a quick look at that. So that's going to be, it's pretty much the same calculation as above, 25,000 times 8% times, so it's going to be the rest of the year, this much. And if we make that calculation times 8%, 8% times the remaining 3/12 of the year, that's £500 for that year. Now it says in the question that the loan was repaid first secured on the 2009, payable to 2010, 11, 12, so that's 3 years. But this is the first year, so we're just looking at costs in the first year. Okay, so what else might not be a capitalizable cost? Well, we've got the general overheads. We couldn't capitalize those, so they'll go in there as well. And we can also add depreciation, because although the building was brought into use on the 1st of April, which is exactly 1 year after construction began, it was actually completed and ready on the 1st of January, and the standards allow for depreciation to begin as soon as it's ready, rather than when it was actually brought into use. So if you're building an office and it's ready on the 1st of Jan, you can do with it what you like. You can depreciate it from that time. If you need to lease it to another party or bring in furniture or decorating, then that's fine. But it's completed and ready for some use, whatever that may be, and you can depreciate from that time. So you can bring in depreciation there. We can't actually give a figure for that. We don't know useful life or depreciation method, but just good to know that depreciation will be part of the income statement costs. So there we have it. Full capex is the construction costs construction costs less general overheads in this case, and the finance costs for the period while construction was going ahead, and we can capitalize those, giving a total in this instance of 29,670.